A retirement surprise that's very avoidable, the tax surprise. High taxes in retirement can erode your savings and even jeopardize your financial security. The biggest source of retirement surprises we see is from retirement account distributions. That's taking money out of plans like 401ks and IRAs. There are two main types of 401k and IRA accounts: pre-tax and after-tax. Pre-tax retirement accounts give you a tax break for making contributions, putting money into them, which is great during your working years when you're trying to save more. However, in retirement, when you're taking money out of these, every dollar you take out is taxable. To see how taking taxable distributions from a retirement account can cause a tax surprise, let's look at an example. Let's say you're retired and your income from things like Social Security, pension, and investment income add up to $103,000. The tax you'll pay on that is at 3 rates. Some of the income will be taxed at 10%, some at 12%, and some at 22%. So you're in the 22% tax bracket, and the federal tax you'll pay on that income is about $17,000. Now, let's say you also need to withdraw some money from your IRA account to pay for some expenses. Let's say you need $25,000 for some additional expenses, and you take it all from your pre-tax IRA account. That $25,000 is additional taxable income, which will take you into the next tax bracket, the 24% tax bracket. So all of that $25,000 will be taxed at 24%. That federal tax adds up to about $6,000 because it's all taxed at the 24% tax rate. And if you're in a state like California that taxes retirement account distributions, you'll also pay state income taxes on that distribution, which will just add to the tax bill. Now, let's look at the situation where the real tax surprise can come from. I call it the tax surprise double whammy. It comes from how you pay the tax on that distribution. In our example, you need $25,000, which is a taxable distribution, and your tax on that is at the 24% tax rate. After those $6,000 of tax are withheld, you'll only end up with $19,000. You need $25,000. So let's say you boost the distribution in order to end up with $25,000 after the tax is withheld. You actually need to distribute $33,000 and have about $8,000 withheld for taxes. As you can see, that's a higher tax rate than you had originally planned for. You can see it's over a 40% increase in taxes. How can you avoid a tax surprise like this? Tax diversification. That means having different assets and accounts you can withdraw from that are taxed differently so that you can more strategically withdraw from those accounts without being accidentally boosted into a higher tax bracket and having a tax surprise. If that sounds daunting, don't worry. This is the kind of thing we help our clients with every day. A certified financial planner can help you build a tax-diversified retirement plan.